February 7th, 2026. A billionaire made a bet. A massive short position designed to crush silver into the ground. Overnight, the price collapsed. $63. Panic spread across trading floors. And then something extraordinary happened. Within hours, silver didn't just recover. It exploded to $78, a 22% reversal in a single session. The short bet didn't just fail, it detonated. And now, the question everyone is asking isn't what happened. It's what comes next. Because the mechanism that destroyed this billionaire's position is still active. Welcome to John Analyst. If you've been watching markets long enough to remember when a handshake meant something, when due diligence wasn't just a checkbox, and when understanding the fundamentals actually mattered, then you know what we do here is different. We don't chase headlines, we analyze the structure beneath them. Now, if that kind of clarity matters to you, if you'd rather understand what's actually moving these markets than be told what to think, go ahead and subscribe. It's just one click, but it tells us you're serious about this. And while you're at it, drop a comment and let us know where you're watching from. New York, London, Singapore, Mumbai. We want to know where the people who still think critically are located. All right, let's get into what really happened and why the next few weeks could rewrite how silver trades for the next decade. February 7th, 2026 will be remembered as the day a billionaire learned that some markets no longer obey the old rules. The trade was textbook. At least, it should have been. A coordinated short position, executed with precision, timed for maximum psychological impact. Designed to trigger a cascade of panic selling that would send silver prices into freefall. And for a few hours, it worked exactly as planned. Overnight, silver plunged from the mid-70s down to $63.98. A brutal, gut-wrenching drop that had traders across Asia and Europe questioning everything they thought they knew about this market. Social media lit up with panic. Forums filled with capitulation posts. The bears were celebrating. And then, the floor gave way beneath them. Because what looked like a successful takedown, what appeared to be a masterclass in market manipulation, turned into something very different. It turned into a trap. By the time London opened, something had shifted. The selling pressure that was supposed to accelerate didn't. Instead, buyers appeared. Not retail speculators chasing a bounce, not algorithmic systems rebalancing portfolios. This was deliberate, institutional, and relentless. Silver began climbing, slowly at first, then with increasing momentum, $65, $68, $72, and the short sellers who had pushed the market down just hours earlier found themselves in a position they hadn't anticipated. They were trapped. Because in the precious metals market, there's a fundamental difference between shorting a stock and shorting a physical commodity. When you short a stock, you're betting on sentiment, on valuation, on future earnings. But when you short silver, you're making a promise. A promise that if someone demands delivery, you can provide the actual metal. And that's where the plan fell apart. By mid-morning in New York, silver had rocketed past $77. At one point, it touched $78.28, a 22% intraday swing from the overnight low to the intraday high. That kind of move doesn't happen by accident. It happens when a market structure breaks, when the assumptions underpinning a trade prove catastrophically wrong, when the people on the wrong side realize there's no exit. The billionaire's position, whatever its exact size, had been designed to exploit what used to be a reliable pattern. Precious metals, historically, could be controlled through futures markets. Sell enough paper contracts, create enough downward momentum, and physical holders would panic and liquidate. It had worked for decades, but February 7th exposed a new reality. The physical silver market has fundamentally changed. Industrial demand from solar panel manufacturing, from electronics, from electric vehicle production, has created a structural deficit. Investment demand, driven by concerns about monetary policy and currency debasement, has remained elevated since 2020. And exchange inventories, those readily available stockpiles that allow futures markets to function smoothly, have been declining for years. They're now at multi-year lows. So when the short attack hit, when the price plunged overnight, the expected wave of panic selling never materialized. Instead, industrial buyers saw an opportunity. Companies that need physical silver for manufacturing, that have locked in production schedules and can't afford supply disruptions, stepped in aggressively. And the moment they did, the moment physical buying absorbed the futures selling, the dynamic reversed, because those short sellers now faced a problem. Their positions were marked to market every hour. As the price climbed, their losses mounted. And at a certain threshold, their brokers would require additional margin or force liquidation. That's when the squeeze accelerated. Automated stop-loss orders triggered, forced buying to cover short positions kicked in, and the price spiraled upward with mechanical precision. This wasn't just silver moving. Gold surged 3.7%, adding roughly $176, closing near $4,955 per ounce. Platinum jumped more than 5%, up about $117. Palladium followed suit. The entire precious metals complex was moving in unison, suggesting this wasn't an isolated event in one market. This was a systemic repricing. And that raises the critical question that most mainstream analysis won't address. If a well-capitalized billionaire couldn't push silver down, if the traditional mechanisms of price suppression no longer function, if physical scarcity now overrides paper market manipulation, what does that mean for the structure of this market going forward? Because the mechanics that destroyed this short position, the supply-demand imbalance, the shortage of physical inventory, the industrial demand that won't disappear, none of that has changed. In fact, it may have just intensified. There's a reason why short attacks on precious metals have worked for so long, and it has nothing to do with fair markets or natural price discovery. It has everything to do with leverage, timing, and the exploitation of a structural weakness that most investors never see, until now. Because what happened on February 7th wasn't just a failed trade, it was the exposure of a playbook that's been used quietly, efficiently, and profitably for decades. Let's start with how it's supposed to work. The classic precious metals takedown follows a predictable pattern. Step 1, identify a moment of low liquidity. Overnight Asian trading sessions, holiday weekends, the 15 minutes before major economic data release. These are the windows where trading volume thins, where order books become shallow, where a concentrated wave of selling can move prices disproportionately. Step 2, deploy massive selling pressure through futures contracts, not physical metal, paper contracts, derivatives that represent silver, but don't require anyone to actually possess it. In the futures market, you can sell contracts worth millions of dollars in silver with only a fraction of that amount as margin. 10-to-1 leverage, 20-to-1 in some cases, which means a relatively small amount of capital can create enormous downward price momentum. Step 3, trigger the psychological cascade. Once the price starts falling rapidly, algorithmic trading systems kick in. Stop-loss orders get hit, momentum-following funds start selling, retail investors panic, and what began as an artificial push becomes a self-reinforcing avalanche. Step 4, cover the short position at a profit. Once the price has dropped sufficiently, the entity that initiated the attack buys back their contracts at a lower price, pockets the difference, and walks away. This strategy has been documented, analyzed, and complained about for years, but it kept working until it didn't. So what changed? What made February 7th different from every other takedown attempt over the past 2 decades? The answer lies in 3 structural shifts that converge simultaneously. First, the physical supply situation. Silver production hasn't kept pace with demand. Major mining operations are aging, ore grades are declining, and new discoveries have been minimal. Meanwhile, industrial consumption has exploded. Every solar panel requires silver paste for conductivity. Every electric vehicle uses significantly more silver than traditional combustion engines. 5G infrastructure, medical devices, water purification systems. The non-investment demand for silver has become inelastic. These aren't speculators who can be shaken out with price volatility. These are manufacturers with production schedules, contracts, and supply chains that can't simply shut down when prices fluctuate. Second, exchange inventory depletion. The COMEX, the London vaults, the Shanghai exchanges, all have seen their readily available silver stockpiles diminish. What used to be hundreds of millions of ounces sitting in registered inventory, available for immediate delivery, has shrunk dramatically. And here's why that matters. Futures markets only function smoothly when there's confidence that physical delivery can occur if demanded. The moment that confidence erodes, the moment market participants suspect there isn't enough physical metal to satisfy contracts, the entire pricing mechanism changes, paper and physical decouple. And when that happens, the leverage that made short attacks profitable becomes a lethal liability. Third, the composition of market participants has shifted. 2 decades ago, precious metals markets were dominated by speculators and hedgers, people who didn't necessarily want the physical metal, who were trading price movements, who could be frightened into selling. Today, a significant portion of long positions are held by entities that specifically want physical delivery. Sovereign wealth funds accumulating strategic reserves, central banks diversifying away from pure fiat currency holdings, industrial conglomerates securing multi-year supply. These players don't liquidate when prices drop. They buy more. So when the Billionaire's short attack hit on February 7th, when the price plunged into the low 60s overnight, the expected panic never came. Instead, a different mechanism activated. Physical buyers absorbed every contract sold, and the moment selling pressure exhausted itself, the moment there were no more willing sellers at those depressed prices, the market discovered something terrifying for anyone holding a short position. There was no supply available to cover. The price didn't just recover, It rocketed because shorts were now forced to bid against each other, against industrial buyers, against long-term holders who had no intention of selling in a market where available physical inventory had already been depleted. This is what's known as a short squeeze. But this wasn't a typical squeeze driven by speculative fervor. This was a squeeze driven by structural scarcity. And that's a fundamentally different and far more dangerous type of market dislocation. The billionaire who initiated this trade made a critical miscalculation. He assumed the market structure of 2026 resembled the market structure of 2010 or 2015. He assumed paper contracts still controlled price discovery. He assumed physical supply was abundant enough to absorb any delivery demands. He assumed fear was still the dominant emotion among long holders. All three assumptions proved catastrophically wrong. And now, the question isn't just what happens to that failed position, it's what happens when other market participants realize the old playbook no longer works. When a billionaire loses a bet, it's usually a private matter. A portfolio adjustment, a quarterly write-down, a quiet restructuring behind closed doors. But when a billionaire loses a bet in a market as interconnected as precious metals, the ripple effects don't stay contained. They spread. And what most people watching silver's violent reversal on February 7th failed to grasp, what the headlines missed entirely, was that this wasn't an isolated event. It was a signal, a warning that the architecture holding together decades of financial assumptions may be fracturing. Let's start with what happened in the broader metals complex that same day. Gold didn't just drift higher. It surged 3.7% in a single session, $176 added to the price, settling near $4,955 per ounce. That's not a normal Friday bounce, that's institutional repositioning. Platinum, historically correlated with industrial cycles and automotive demand, jumped more than 5%. Palladium followed. Copper showed strength. Even base metals that have nothing to do with monetary policy or safe haven demand were moving in tandem. This wasn't a silver story anymore. This was a commodity complex-wide repricing event, and that raises an uncomfortable question. What were institutional players seeing that triggered simultaneous buying across multiple metal markets? The timing is critical. Because February 7th wasn't just about a failed short position. It coincided with a notable pause in the US dollar's rally. For weeks, the dollar had been climbing against major currencies, grinding higher on expectations of divergent monetary policy, on safe haven flows amid global uncertainty. But the moment silver reversed, the moment the metals complex caught a bid, the dollar stopped rising. Currency traders began reassessing. And here's where it gets interesting. Because the dollar's strength had been predicated on a specific narrative. The narrative that U.S. assets, U.S. yields, U.S. financial instruments represented the safest, most liquid place to park capital in an unstable world. But if precious metals are surging, if physical commodities are outperforming financial assets, if even a coordinated attempt to suppress prices can't hold them down, then that narrative has a problem. It suggests capital is beginning to question the real value of fiat-denominated returns. And once that question enters institutional decision-making, once allocators start wondering whether a 3% yield on a 10-year treasury is actually a positive return when measured against hard asset appreciation, the flow of capital changes direction. Now, let's talk about the part that should concern anyone with exposure to financial markets. Derivatives. We know a massive short position was deployed against silver. We know it failed catastrophically. We know the price reversed 22% intraday. What we don't know, what hasn't been disclosed, what may not be fully understood even by regulators, is the total notional value of derivative contracts tied to that position. And more importantly, who the counterparties are. Remember, in derivatives markets, every position has two sides. For every short, there's a long. For every bet that prices will fall, someone else is on the other side of that trade. And when a position blows up, when margin calls go unanswered, when forced liquidation occurs at unfavorable prices, the losses don't just disappear, they get transferred to clearinghouses, to prime brokers, to financial institutions that provided the leverage. History has shown us what happens when derivative exposure concentrates risk in ways that aren't immediately visible. Long-term capital management in 1998, a hedge fund collapse that nearly took down the global financial system because nobody understood how interconnected the derivative positions were until it was too late. Archegos Capital in 2021, a family office that imploded, forcing banks to liquidate billions in positions, exposing hidden leverage that compliance departments never flagged. Credit Suisse's derivative book, which contributed to a historic banking crisis when counterparty risk became unmanageable. The common thread? Leverage, opacity, and the assumption that risk was contained right up until the moment it wasn't. So when a billionaire's short bet on silver detonates in a single session, the The immediate question isn't just about that one position. It's about the derivative chain attached to it. How many other institutions have exposure? How much leverage was embedded in related trades? Are there other positions in other commodities, structured the same way, that are now vulnerable? Because silver didn't move in isolation on February 7th. The entire precious metals complex moved. And if there are similar short positions in gold, in platinum, in palladium, positions built on the same assumptions, the same leverage, the same belief that paper contracts control physical markets, then what happened in silver could be a preview, not an anomaly, a template. Now let's zoom out further, because there's a geopolitical dimension to this that can't be ignored. For the past 2 years, the BRICS nations have been actively discussing alternatives to dollar-dominated trade settlement. Not hypothetically, actively. Russia, China, India, Brazil, South Africa, and now expanding membership, all exploring mechanisms to conduct bilateral trade without routing transactions through the U.S. financial system. And a recurring theme in those discussions? Commodity-backed settlement systems, gold-backed trade instruments, currency swaps tied to energy and metals, strategic resource agreements that bypass traditional forex markets. This isn't conspiracy theory. This is documented policy discussion at the highest levels of government. And if major economies are building infrastructure to trade outside the dollar system, if they're accumulating physical gold and strategic metals as backing for alternative payment mechanisms, if they're reducing their reliance on Western financial institutions, then the demand profile for precious metals changes fundamentally. It's no longer just about investment demand or industrial consumption. It becomes about monetary system architecture. And that kind of demand doesn't respond to futures market manipulation. It doesn't panic sell when prices drop. It accelerates purchases when prices appear artificially suppressed. Which brings us back to February 7th. A billionaire tried to crash silver using methods that worked for decades. The market absorbed the attack, reversed violently, and exposed the limitations of paper-based price control. Gold, platinum, and palladium all surged in sympathy. The dollar paused its rally. Risk assets bounced. And somewhere, in trading rooms from New York to Shanghai, analysts are asking the same question. If the old mechanisms of control are breaking down, if physical scarcity is beginning to override financial engineering, if commodity markets are decoupling from the assumptions that governed them since 1971, well, what comes next? Because the answer to that question won't be found in technical analysis or chart patterns. It will be found in the structural reality of supply, demand, and the limits of leverage in a world where physical assets are reasserting their value. The failed short attack on February 7th created something rare in financial markets. Clarity. Not about what will happen, but about what's no longer possible. For decades, the precious metals market operated under a set of assumptions that allowed sophisticated players to control price movements with relative predictability. Those assumptions are now in question. And when foundational assumptions break, when the rules that governed a market for 50 years stop working, everything that comes next operates under different physics. So the question facing anyone with exposure to commodities, to currencies, to the broader financial system, isn't whether silver will hit $80 or $90 next week. The question is, what happens when markets realize that price suppression through paper contracts may no longer be viable? Because if it doesn't work in silver, it probably doesn't work in gold either, or platinum, or any physical commodity where supply is constrained and industrial demand is inelastic. And that is a systemic problem. Now let's start with the technical picture as it stands today. Silver established resistance in the $78 to $80 range. That's the ceiling it hit during the intraday spike on February 7th before settling back slightly. Support appears to have formed above $70, which means the trading range has shifted upward by roughly $10 to $15 in a single session. That's not normal volatility. That's a structural repricing. Volume during the reversal was significant, suggesting institutional participation, not just retail speculation. And here's what matters most. Open interest data indicates that short covering is incomplete. There are still positions that were opened at lower prices, still traders holding shorts who haven't exited, still exposure sitting on books that becomes increasingly dangerous the longer prices remain elevated, which means the squeeze dynamic, the mechanism that drove prices higher on February 7th, is still active. It hasn't resolved. It's paused. And in markets, a paused squeeze is often more dangerous than an active one because it creates a binary setup. Either the pressure dissipates, shorts cover gradually, and the market stabilizes, or something triggers the next waves and the move accelerates. So let's walk through the three most probable scenarios for the coming weeks. Scenario A, continued upward squeeze. If short covering accelerates, if industrial buyers continue aggressive purchasing, if investment demand returns as momentum builds, silver could test $85 to $90 rapidly, possibly within 2 to 3 weeks. This scenario becomes more likely if gold continues climbing, if the dollar resumes weakness, if any negative headline about banking stability or sovereign debt emerges. The risk in this scenario isn't just higher prices. It's the possibility of a parabolic move that draws regulatory attention. Historically, when commodity markets move too violently, too quickly, governments intervene, position limits get imposed, margin requirements increase, trading halts occur, and those interventions don't happen to protect the market. They happen to protect the entities on the wrong side of the trade. Scenario B, consolidation and range-bound trading. This is the most probable near-term outcome. Prices stabilize between $72 and $78 for several weeks. The market digests the recent volatility, allows short interest to unwind gradually, and establishes a new equilibrium at higher levels than before. Physical premiums remain elevated, indicating tight supply, but spot prices range rather than trend. This scenario requires that no external shocks occur, that broader financial markets remain stable, and that industrial demand doesn't accelerate unexpectedly. It's the path of least resistance, but it's also the most fragile because it depends on nothing going wrong. And in the current global economic environment, that's an optimistic assumption. Scenario C, external shock triggers, broader reset. This is the low probability, high impact scenario. A banking sector stress event, a sovereign debt crisis in a major economy, a geopolitical disruption to commodity supply chains. Any of these could shift precious metals from a tactical trade into a systemic hedge. In this scenario, silver doesn't just outperform other assets. It enters a historic bull phase driven by monetary instability and real asset scarcity. The ratio of silver to gold, which historically averages around 60 to 1, could compress dramatically if industrial demand combines with monetary demand. This scenario is unlikely in the immediate weeks ahead, but the probability increases with time because the underlying conditions, excessive sovereign debt, fragile banking systems, geopolitical tension, resource nationalism, none of those are improving, they're worsening. Slowly, incrementally, but consistently. Now, let's talk about what this means for strategic decision-making. If you're a company with silver in your supply chain, the lesson from February 7th is that prices are no longer predictable based on historical patterns. Forward purchasing agreements, physical inventory accumulation, and hedging strategies need to be reassessed immediately. Waiting for prices to come back down may be waiting for a condition that no longer exists. If you're an industrial manufacturer dependent on silver for production, supply security is now a greater risk than price volatility. The failed short attack revealed how thin available inventory has become, which means the next disruption, whether from a mine closure, a logistics breakdown, or another market dislocation, could leave you unable to source material at any price. That's not a financial risk, that's an operational risk. If you're a financial institution with commodity derivative exposure, the events of February 7th should trigger an immediate review of counterparty risk. Who is on the other side of your trades? What leverage are they using? What happens if another short position blows up and forces liquidation across multiple markets? Because the assumption that clearinghouses and margin systems will contain the damage, that assumption failed in 2021 with Archegos. It failed in 2023 with Credit Suisse. It will fail again. The only question is when. And for investors, for wealth allocators, for anyone managing capital in this environment, the strategic question isn't whether to own precious metals. It's what percentage of a portfolio should be in assets that can't be printed, debased, or manipulated through leverage. Because what happened on February 7th wasn't just about silver. It was about the limits of control in a system built on leverage and confidence. And when control mechanisms fail, when confidence erodes, the assets that retain value are the ones with intrinsic scarcity and no counterparty risk. Physical commodities, hard assets, resources that exist independent of financial engineering. Now, here's the part that should concern policymakers. If precious metals markets are decoupling from paper-based price discovery, if physical scarcity is overriding futures market manipulation, if the mechanisms that kept commodity prices stable for decades are breaking down, then the risk isn't just higher gold and silver prices. The risk is instability in the broader commodity complex. Energy, agriculture, base metals, all of them trade on similar structures. All of them rely on the assumption that paper contracts can manage physical supply and demand. If that assumption is failing in precious metals, it will fail elsewhere. And when it does, the phrase commodity supercycle won't be an analyst's talking point. It will be an economic reality that reshapes everything from inflation expectations to geopolitical power dynamics. So what happens next? The honest answer is that no one knows with certainty. But the parameters are clear. Physical silver supply is constrained. Industrial demand is inelastic. Exchange inventories are depleted. Leverage-based price suppression has proven ineffective. And the broader macroeconomic environment, excessive debt, monetary instability, geopolitical fragmentation, is creating conditions where hard assets reassert their role as stores of value. The billionaire who shorted silver on February 7th learned a lesson. The market has changed. The question now is whether the rest of the financial system recognizes that change before the next dislocation occurs, because the next one won't be contained to a single commodity. It will spread. And when it does, the people positioned in physical assets will be the ones who saw it coming. The ones still holding paper promises will be the ones asking what happened.